Imagine you are the chief financial officer of a Fortune 500 company, right? Oh. And you just authorized a $400 million purchase of heavy, rapidly depreciating computer hardware.
Okay, yeah. That is a massive chunk of capital.
Right, but here's the catch. You aren't actually deploying it. You're just, letting it sit on pallets in a massive warehouse.
This is wild. I mean, in normal times, tying up nearly $500 million in static inventory like that, well, that would be a fireable offense for a CFO.
Exactly. You'd be out the door. But right now, in the exact environment we're operating in today, that decision might actually be like the most brilliant defensive moat in the entire technology sector.
It really is. It completely flips the traditional script on capital allocation because, we've been trained for the last 2 decades to just worship just-in-time inventory.
Right, keep the balance sheet light.
Exactly. The idea was always to be as lean as possible. But when the resource you're holding becomes the critical bottleneck for the entire global economy, being heavy is suddenly your biggest competitive advantage.
And heavy is definitely the right word here. Because I think we're looking at a fundamental misunderstanding in how most people are viewing the current artificial intelligence boom.
Oh, absolutely. There is this pervasive idea that AI is just a software phenomenon.
Yeah, it feels frictionless to the user. You type a prompt and the result just magically appears on your screen.
But when a multinational corporation or, a state government actually wants to deploy this technology securely and at scale, there is no magic.
None at all.
It requires thousands of pounds of servers, immense cooling infrastructure, like miles of copper wire. The logistical operations look way more like industrial manufacturing than Silicon Valley software coding.
We're talking about heavy physical reality, which is exactly why the financial data we are unpacking today in this deep dive is so critical for you to understand as an investor.
You really have to look past the companies building the algorithms and focus on the companies that are actually pouring the concrete, so to speak.
Exactly. And the data we're dissecting today comes directly from CDW Corporation's Q2 2026 earnings call.
CDW is such a fascinating case study for this right now.
Right, because for those of you holding or considering the stock, CDW isn't the flashy AI startup making headlines on social media. They are the essential middleman, the general contractors of the enterprise tech world.
They take all that disparate, highly complex hardware and software, and they actually make it work inside a massive corporation's existing ecosystem.
So we are going to tear into their Q2 numbers today. Because these figures don't just tell us about one company's performance, right? They act as this real-time ledger showing us exactly where the enterprise world is physically spending its capital to survive the AI transition.
It's the ultimate scoreboard for corporate tech spending.
So let's jump straight to that scoreboard, because these headline numbers are massive. Net sales for the quarter hit a record $6.6 billion.
Wow.
Yeah, that is a 10% year-over-year increase.
And you have to put that into context, right? Getting a 10% top-line bump when your revenue base is already in the multi-billions, that is incredibly difficult.
Especially in this macro environment.
Precisely. Particularly when you factor in the broader macroeconomic volatility we've seen in the first half of 2026. I mean, this isn't a startup doubling its revenue from 1 million to 2 million.
Right. This is a massive battleship accelerating its momentum.
Exactly. And it flows straight down to the bottom line, too.
Let's talk about that bottom line. Non-GAAP earnings per share came in at $2.91. That is up 12% year over year.
Which, by the way, sets another all-time record for them.
Yeah. And what's wild is management's own guidance was projecting high single-digit EPS growth. So hitting 12% just completely shatters their internal estimates.
It really does. Plus, non-GAAP operating income reached $556 million, which is up 7%.
Okay, so let's pause here. Revenue is at record highs, EPS is beating estimates, and operating income is climbing. But there is a glaring discrepancy here that I want us to unpack for the listener.
Oh, I know exactly what you're going to bring up, the margins.
Yeah. Their gross margin dropped by 70 basis points to 20.1%.
And honestly, that 70 basis point compression is probably the single most important data point in this entire earnings report.
Really?
Yeah, because it forces you to look under the hood. For those newer to the jargon, by the way, basis points are just a way of measuring percentages. So a 70 basis point drop simply means a 0.7% drop in their gross margin.
But I have to challenge the mechanics here, because if you're selling $6.6 billion worth of technology and your EPS is growing at 12%, how on earth are your margins shrinking?
It sounds contradictory, right?
Totally. Usually when a company scales up its sales to record highs, they get operational leverage and their margins expand. Shrinking margins during a record sales quarter just feels wrong. Are they like discounting heavily just to move volume?
Are they buying revenue at the expense of profitability?
Exactly. Are they just slashing prices?
It is a totally valid suspicion. And look, if this were a consumer retail company, shrinking margins on record sales would be a massive red flag. It would indicate a race to the bottom on pricing.
Right, like trying to clear out winter coats in April.
Exactly. But CDW operates in the enterprise channel. And this margin compression has absolutely nothing to do with discounting.
Okay, so what's driving it?
To understand the how and the why behind that margin drop, you have to look at the exact product mix driving that $6.6 billion. You really have to separate what they're selling into two distinct categories.
Let's look at the drivers then. The transcript breaks down their segment performance, and this is where I think it gets really fascinating. Hardware revenue skyrocketed 10%.
Massive growth there.
We were talking about servers, massive storage arrays, enterprise networking gear. All of those saw double-digit growth. Even PC and desktop sales rose 10%.
But there's a caveat with those PC numbers, right?
Yeah, management made a very specific note that this PC growth was driven by higher average selling prices, or ASPs, rather than a massive influx of sheer volume.
Which tells us a ton about the hardware refresh cycle happening right now.
How so?
Well, the 10% bump in PCs isn't because companies are just hiring 10% more employees and buying them standard run-of-the-mill laptops.
Right.
It's because the existing workforce is being upgraded to AI-enabled machines. These units require dedicated neural processing units, significantly more RAM, and, advanced thermal management so they don't melt down on your desk.
So they are just inherently more expensive machines.
Exactly. Enterprise IT buyers are accepting these higher average selling prices because running localized AI tasks directly on the endpoint, like on the laptop itself, is becoming a security and latency necessity.
But the real story's in the data center hardware, right? The heavy stuff.
Oh, absolutely. The heavy stuff, the servers and the storage.
So you have this massive 10% surge in heavy hardware. Now, compare that against the other side of their business, their services segment.
Which is traditionally their high margin business, by the way.
Right. But services only increased by a meager 1%. So hardware is booming, but services are essentially flat.
And there's the answer to the mystery of the 70 basis point margin drop. It is purely a shift in the revenue mix.
I want to run an analogy past you to see if we can visualize this mechanism clearly for you guys listening. Let's imagine CDW's enterprise clients are undertaking a massive commercial real estate project. Like they are building a skyscraper.
Okay, I like where this is going.
Right now, in this initial phase of the AI adoption cycle, these companies are buying the foundational materials. They are buying the poured concrete, the steel I-beams, the massive HVAC system.
The essential heavy stuff.
Exactly. And in the IT world, that's the servers, the storage racks, the physical networking switches. That material is incredibly expensive, and it generates massive top-line revenue.
But for the general contractor, CDW in this case, it yields a relatively lower profit margin.
Right. It's essential, but the markup on raw steel isn't where you make your highest percentage of profit.
That perfectly captures the dynamic.
Yeah.
The concrete literally has to cure before you can do anything else.
Exactly. And the high margin work, the interior decorating, the custom architectural details, the specialized security systems, that all comes later.
And in CDW's world, that interior decorating is the software integration, the cybersecurity monitoring, the cloud optimization, and all those lifecycle management services.
You literally cannot deploy those high margin services until the physical hardware infrastructure is bolted in, powered on, and networked.
Exactly. So right now, CDW is selling billions of dollars of concrete and steel. It drives revenue through the roof. But because the mix is so heavily skewed toward that lower margin hardware, the blended gross margin compresses by 70 basis points.
Which means that 70 basis point drop isn't a symptom of a broken business model at all.
Not even slightly. It is a perfectly natural, highly predictable symptom of the current phase of the enterprise AI adoption cycle.
And CDW's CFO, Al Morales, basically confirmed this exact dynamic on the call, right?
He did. He pointed out that this heavy infrastructure investment is being driven primarily by their largest enterprise and corporate customers. The heavy hitters are moving first.
So they're ripping out their legacy data centers and building the physical capacity required to handle AI workloads.
Yeah, and as CEO Chris Leahy noted, this infrastructure investment comes first, followed by the services, software, and lifecycle opportunities.
So the high-margin interior decorating phase is coming. It just hasn't hit the income statement in full force yet.
It's an adoption wave. And what is particularly telling is where this wave is hitting geographically.
You're talking about the international numbers.
Oh, yeah?
Because the transcript showed international sales were a massive bright spot, up 23% overall, and led specifically by a record quarter in Canada.
Which is such an interesting data point.
Yeah, why Canada? Why is the international segment growing at more than double the rate of the overall business?
It speaks to the reality of data sovereignty and global compliance.
Okay, break that down for us.
Well, for the last decade, a company in Toronto might have been perfectly happy hosting their data on a cloud server sitting in Virginia.
Right. The borders didn't really matter for cloud storage.
Exactly. But artificial intelligence changes the entire risk calculus. When you are processing proprietary corporate data or customer communications or like sensitive financial models through an AI system, you suddenly run into severe regulatory walls.
Oh, because the AI is actually reading and learning from that data.
Precisely. Countries are waking up and realizing that AI infrastructure is critical national infrastructure.
So Canadian enterprises can't just rely on US-based AI data centers anymore. They have to build their own local capacity to ensure their data doesn't cross borders.
Exactly. This forces a massive localized hardware build-out. And because CDW has an established international footprint, they are capturing that localized infrastructure surge perfectly.
That makes total sense. Which actually brings us back to that $400 million inventory build we talked about at the very beginning of the deep dive.
Yes, the pallet sitting in the warehouse.
Right. Let's look at the cash flow statement, because this is where a lot of retail investors might get really spooked if they don't understand the underlying strategy here.
It does look alarming on paper.
Yeah, free cash flow conversion for the first half of the year was sitting at 42% of non-GAAP net income. Now, CDW's historical target, their stated rule of thumb is converting 80 to 90% of their net income into free cash flow.
So dropping to 42% is a severe deviation from the norm.
Yeah, and when cash conversion plummets like that, it usually means a company is bleeding capital.
But the call transcript explicitly outlines that this wasn't an operational bleed at all. It was a proactive, intentional, working capital decision. They tied up $400 million in inventory.
Right. And I want to dig into why they did that and how they managed the pricing on that inventory. Let's talk about the supply chain environment right now, because the call specifically cited severe memory price inflation and ongoing component shortages.
You really have to put yourself in the shoes of CDW's management team for a second. They are looking at a landscape where every major enterprise on Earth is suddenly scrambling to buy the exact same high-performance servers, the exact same specialized networking gear, and the exact same advanced memory modules.
It's a gold rush for the physical hardware.
Exactly. And when demand shocks the system that violently, supply chains just choke. Lead times stretch from weeks to months or even quarters.
And if you are a CIO who has been mandated by your board of directors to implement an enterprise-wide AI strategy by the end of the fiscal year, you literally cannot wait 9 months for a server rack.
You absolutely cannot. You lose your job. So CDW uses its massive balance sheet as a weapon here. They step into the market, they buy up $400 million worth of this critical, highly constrained hardware, and they warehouse it.
Just hoard it.
Yep. Yes, it hammers their short-term free cash flow conversion. Yes, it looks ugly on a quarterly snapshot, but think about the leverage it gives them.
I see where you're going with this.
When that desperate CIO calls around looking for immediate infrastructure deployment, everyone else tells them they have to wait 2 quarters.
Yeah.
CDW says, we have it on a pallet, we can ship it tomorrow.
It's a strategic moat disguised as an accounting negative. That's brilliant. But what about the risk of holding all that hardware in an inflationary environment?
What do you mean?
Well, if memory prices are skyrocketing and CDW has already bought the gear, how do they ensure they don't get squeezed on profitability when they finally sell it months later?
This is where we need to examine their pricing model, which analysts refer to as a cost-plus regime.
I really want to focus on the mechanics of that because it is crucial for evaluating their pricing power. Walk us through how a cost-plus regime actually functions in real-time negotiations with these enterprise clients.
It is a brutally efficient mechanism for protecting margins against inflation. I mean, think about a standard retail environment, right? A company sets a fixed catalog price for an item.
Like a laptop on a shelf at Best Buy.
Exactly. If their internal costs go up, they either have to eat the loss and accept lower margins, or they have to risk alienating the customer by raising the catalog price.
Right.
But in enterprise IT, under a cost-plus model, the price the customer pays is dynamically linked to the cost CDW pays the manufacturer.
Okay, so let's run a scenario here. Let's say a massive hospital network is upgrading its internal data centers to run diagnostic AI models. They budget $20 million for the hardware phase. But between the time they budget and the time they actually sit down to finalize the purchase order with CDW, the global price of enterprise memory spikes by 15%.
All right, common scenario right now. In a cost-plus regime, CDW takes that 15% cost increase from the manufacturer, adds their standard contractual gross margin percentage on top of it, and presents the new higher total to the hospital network.
They just pass the inflation directly to the buyer.
Exactly.
But here is the critical question, and this is where pricing power is truly tested. Why doesn't the hospital network CIO just push back? Why don't they threaten to go to a competitor to get a better price?
Because of that $400 million inventory moat we just discussed.
Yeah.
The CIO is trapped by necessity. They can go to a competitor to try and haggle over a few percentage points, sure, but the competitor doesn't have the hardware in stock.
Oh, wow. Yeah.
The competitor is going to put them at the back of a 6-month waiting list. CDW is essentially saying, look, the price is the price, dictated by the market, but we can solve your problem today.
And we know this mechanism is holding firm because during the Q&A portion of the earnings call, one of the analysts specifically grilled management on this.
They did, yeah.
They asked if there were any instances where CDW couldn't price on a cost-plus basis because of intense customer pushback. And Al Morales, the CFO, flatly said no. They maintained absolute pricing discipline.
Which is the ultimate validation of their market position. If your customers willingly absorb significant price increases without walking away, it proves that the product you're supplying is mission critical, and your ability to deliver it quickly is highly valued.
Speaking of Al Morales, there was a significant management note tucked into the call. He announced his intention to retire, but not until 2027.
Which, from a governance perspective, is exactly what you want to see as an investor.
Really? A CFO leaving is good.
Well, it's about how they leave. When a CFO abruptly resigns to spend more time with family, it usually signals an internal crisis or a looming accounting disaster.
Right, the classic sudden departure.
Yeah, but announcing a retirement a year or more in advance is the hallmark of a disciplined, highly coordinated management team. It guarantees an orderly transition, allows for a comprehensive search for a successor, and, prevents any unnecessary market panic.
Okay, so we've established the mechanics of what drove the Q2 numbers. We have massive hardware demand forcing them to act as a shock absorber for the supply chain, which temporarily depresses cash flow and slightly compresses margins. All while top-line revenue and bottom-line earnings break records.
That is the reality of the business today, perfectly summarized.
But investing is about the future, right? So let's look at the third critical component of this call, management guidance. What are they telling us about the rest of 2026? Because honestly, I found their forward-looking statements to be, well, a little bit contradictory.
Let's parse out the exact guidance they provided.
All right, so on the macro level, for the full fiscal year of 2026, management officially raised their outlook. They are now projecting gross profit to grow in the mid-single digits for the year.
A solid raise.
And crucially, they stated that full-year EPS growth is projected to come in at the high end of their high single-digit range. So when looking at the whole year, they are very confident.
Yes.
But then they gave specific guidance for Q3 just the very next quarter, and the tone shifted dramatically. They guided for gross profit in Q3 to remain entirely flat sequentially compared to Q2.
Which inherently implies that Q3 top-line revenue might actually be slightly down, or at best stagnant, quarter over quarter.
And this is where I have to push back on management's narrative. If you read the transcript closely, they repeatedly emphasize how strong their underlying metrics are. They explicitly stated that written demand and shipping activity remain incredibly robust.
Right.
In fact, they noted that new writings, meaning signed contracts and purchase orders, were heavily exceeding their actual invoicing.
That is a critical operational detail. Let's define that for a moment, because it matters.
Go ahead.
Written demand is the commitment. The client has signed on the dotted line. Invoicing is when the hardware actually leaves the loading dock and the revenue can be recognized on the income statement.
Exactly. So if your written demand is heavily exceeding your ability to invoice, it means you have a massive growing backlog of guaranteed business.
You do.
So if you have more orders coming in than you can even process, and the AI supercycle is accelerating, why on earth is management guiding for a flat third quarter? Are they intentionally sandbagging the numbers just so they can easily beat expectations in 3 months and look like heroes?
It is a very fair critique.
Yeah.
And it is precisely the tension the Wall Street analysts homed in on during the call. But I wouldn't classify it as sandbagging, personally.
What would you call it?
I would classify it as calculated, defensive prudence in the face of macro uncertainty.
Prudence. That is the classic Wall Street euphemism for we see something scary on the horizon. What are they actually afraid of if their own order books are overflowing?
You have to zoom out and look at the environment they're operating in. Yes, their internal metrics are blazing hot. The AI demand is ferocious. But CDW does not operate in a vacuum. We were talking about Q3 of 2026.
Right.
The macro environment is still highly volatile. You have ongoing geopolitical tensions that could instantly disrupt the semiconductor supply chain in Asia. You have persistent inflationary pressures on enterprise budgets. You have interest rates heavily impacting the cost of capital for their clients.
So they have a massive backlog, but they are acknowledging that external shocks could delay their ability to fulfill those orders or cause clients to ask for deferred deployment schedules.
Exactly. By guiding for a flat Q3 sequentially, management is essentially establishing a high watermark floor.
Setting expectations carefully.
Yeah, they are signaling to the market, look, even if the macro environment throws us a curveball, even if supply chains tighten further, we have enough momentum to maintain the record-breaking baseline we just set in Q2.
It gives them a massive margin of safety.
Exactly. If the macro environment cooperates, they will easily beat that flat guidance. But if a shock occurs, they haven't overpromised.
But what if revenue actually does cool? Let's say the macro environment bites hard and some of these massive enterprise hardware deployments get pushed into 2027. If revenue stays flat, how do they guarantee they hit that raised EPS target for the full year?
That brings us to a specific internal initiative they kept mentioning on the call.
The Geared for Growth program.
Yes, and this is where the mechanics of corporate management become incredibly important for retail investors to understand.
When I see a phrase like geared for growth in an earnings transcript, my immediate reaction is that it's just sanitized corporate speak for aggressive budget cuts and layoffs. Is that what this is?
It is a corporate efficiency program, certainly. But classifying it merely as budget cuts misses the strategic leverage it provides.
Okay, unpack that.
CDW is a massive organization. Over time, particularly during periods of rapid expansion, administrative bloat, redundant software licensing, and inefficient internal processes naturally accumulate.
Sure, corporate bloat is real.
The Geared for Growth initiative is designed to ruthlessly optimize their own SG&A, their selling, general, and administrative expenses.
But how does an IT middleman actually execute that without damaging their ability to serve their clients? If you are managing complex logistics for Fortune 500 companies, you can't just fire half your support staff to juice the quarterly numbers.
No, you don't do it by firing the people executing the core business. You do it by applying the very technology you sell to your own internal operation.
Oh, that makes sense. Eating their own cooking.
Exactly. They are likely automating their own back office processes, consolidating their internal IT infrastructure, and streamlining their supply chain logistics. But what is crucial here is the timing of this initiative.
Right, because CFO Al Morales explicitly stated that the financial benefits, like actual cost savings of this Geared for Growth program, are going to aggressively hit the income statement in the second half of the year.
Yes.
So that is the safety net.
Precisely.
Yeah.
Let's connect the dots here. In the first half of the year, CDW delivered their massive operating income growth primarily through sheer volume and good old-fashioned pricing discipline.
Right, selling more stuff at cost plus.
But as they move into Q3 and Q4, this efficiency program acts as an artificial booster to their operating leverage.
Let me make sure I'm synthesizing this correctly for you guys listening. Management is guiding for flat revenue in Q3 to protect themselves against macro volatility. But because the Geared for Growth cost savings are kicking in simultaneously, their operating expenses as a percentage of that flat revenue are going to drop significantly.
You have it exactly. It is a dual engine strategy for profitability. Even if the top-line revenue engine stalls slightly due to external economic headwinds, the bottom-line efficiency engine fires up, ensuring that their EPS continues to grow.
They are completely insulating their earnings from potential revenue volatility.
It's very smart management.
Okay, we have covered a tremendous amount of ground here. We have dissected the record-breaking sales driven by this massive urgent hunger for physical AI hardware.
Yep.
We understand the mechanics behind the slightly compressing gross margins. They're in the pouring concrete phase of the adoption cycle.
Right.
We see how a $400 million inventory build acts as an essential defensive moat rather than a careless capital drain. And we've unpacked how a calculated flat guidance combined with an aggressive internal efficiency program guarantees their profitability for the rest of the year.
All of this data paints a very specific picture of the corporate tech landscape.
It does. But we need to boil this down to the ultimate insight. For the person holding this stock or thinking about allocating capital to it, what is the bottom line verdict here?
The verdict, based purely on the data presented in this Q2 call, is clearly bullish. This earnings report is a masterclass in demonstrating why CDW is a premium infrastructure play for the artificial intelligence supercycle.
It really provides a remarkably clean alternative to the guessing game that most AI investors are currently playing.
Oh, the guessing game is brutal right now.
Right now, retail investors are agonizing over which software platform is going to win. Do you bet on the massive frontier model creators? Do you bet on the open source community disrupting them?
Do you try to find the niche application layer startup? It is incredibly risky to try and pick the ultimate software winner at this stage of a technological revolution.
It is nearly impossible, but the beautiful reality of CDW's business model is that you don't have to pick the software winner.
Not at all.
It fundamentally does not matter to CDW whether a Fortune 500 company decides to run their models on proprietary software or open source architecture.
Right. Whoever wins and whatever software they run, they absolutely must have the localized servers, the specialized high bandwidth networking, the massive data storage arrays, and the enterprise-grade cybersecurity to run it safely.
CDW supplies the foundational physical layer that makes all of the software possible.
They're the ultimate general contractor.
But I want to make sure we don't gloss over the red flags, because for a retail investor running a quick stock screener, a 70 basis point margin drop and a free cash flow conversion rate that is half of its historical target.
Yeah.
That can look terrifying.
And that is exactly why we do these deep dives, because context is everything. If you are holding this stock, you have to mentally map that 70 basis point margin drop to our construction analogy.
It is a natural, healthy phase of a massive technology adoption cycle.
Yes. The enterprise giants have to lay the heavy, lower margin groundwork first. Once that physical infrastructure is bolted into the server racks and powered on, the secondary wave hits.
And that secondary wave is the high margin services, the ongoing cloud optimization, the security monitoring, the lifecycle management.
And CDW is already embedded with these clients. They sold them the concrete, and they are perfectly positioned to sell them the interior decorating over the next 3 to 5 years.
And what about the cash flow optics, the 42% conversion rate?
As we've detailed, tying up $400 million in inventory was a deliberate, strategic masterstroke in a supply-constrained world. They guaranteed product availability for desperate corporate clients who couldn't afford to wait out supply chain bottlenecks.
That action builds a level of trust and long-term vendor loyalty that you simply cannot buy with a traditional marketing budget.
Exactly. Furthermore, management explicitly expects that cash conversion ratio to normalize back toward their 80 to 90% target range by the end of the year as that inventory is progressively invoiced and deployed.
And perhaps the most compelling argument for retail investors is that while you are waiting for that high-margin services cycle to fully kick in, you are literally being paid to be patient.
That's the dividend.
Yeah.
Exactly. CDW is not a speculative cash-burning growth stock. They operate with a target dividend payout ratio of roughly 25% of their non-GAAP net income.
So they have a history of disciplined capital return.
They do.
So you have a company that offers direct, massive exposure to the physical build-out of the AI boom, combined with the financial stability and capital return policies of a seasoned, mature enterprise.
It really is the heavy plumbing of the modern internet.
Yeah.
Completely overhauled for the artificial intelligence era.
But before we wrap up this analysis, there's one final thread from this earnings call that I want to pull on. It's something that really struck me when management started providing specific examples of what this hardware is actually being used for.
Oh, the specific use cases are often the most telling part of these calls. Let's hear it.
CEO Chris Leahy took a moment to highlight two specific major recent wins for the company. One was a Mythos AI security vulnerability program that they deployed for a massive financial services company.
Yep.
And the other was a multi-million-dollar AI sandbox infrastructure project for a state government.
Very high-stakes clients.
Exactly. And she made a very specific, almost chilling observation. She noted that as artificial intelligence scales across the economy, large organizations are being forced to manage a rapidly growing gap between the massive volume of new AI-driven cybersecurity threats and their physical ability to remediate those threats.
Oh, wow. It creates a terrifying architectural challenge for a chief information security officer.
I can't even imagine.
Right. When the threats are automated and learning at machine speed, your defenses have to be equally robust and localized.
Exactly. And that realization completely shifts how we might view the ultimate economic impact of this technology. So I want to leave you with a provocative thought to mull over as you analyze the tech landscape.
Let's hear it.
We are currently caught in a narrative that artificial intelligence is the ultimate productivity tool, that it will streamline operations, cut costs, and generate immense new efficiencies. But if deploying this technology forces legacy financial institutions and massive state governments into endless multi-million-dollar security, governance, and compliance infrastructure upgrades just to keep their existing proprietary data safe from AI-driven attacks.
Are they actually gaining anything?
Exactly. Is the real long-term financial value of the AI boom actually just a desperate permanent race for corporate cybersecurity? Are we actually building a utopian productivity engine, or are we just creating the world's most complex, incredibly expensive lock and key system?
It is a profound structural question. If the perimeter of a company's network is constantly expanding and evolving because of AI at the edge, the cost of securing that perimeter is no longer a one-time capital expenditure.
It's never finished.
No, it becomes a massive, permanent, and ever-growing recurring line item on the income statement.
Which means the companies selling the locks and the keys might just be the most secure investments of the entire cycle. So take a hard look at the companies in your own portfolio. Examine their roles in this ecosystem. Do you own the heavy lifters, the companies getting paid billions to build physical foundation, warehouse the critical infrastructure, and secure the expanding perimeter? Or are you just holding on to the weightless, frictionless hype?